Hey guys, it's Vector Trading FX. We're back with another video. This video is something not a lot of people actually go over, and it's targeting your trades. So in general, people like to say kind of, just target 5 to 1, 6 to 1, 7 to 1, which is okay, especially when you're starting. But you can basically target the correct area every time if you understand where price is trying to run to next. The main idea is that we want to target the next area of reversal. So before we get into this, let me explain what I mean by that. So if we have a demand and then we have an inducement for it, and then let's say we break the high of the inducement and we sweep into a nice zone here formed from the left. Let me just draw that in. Like so, something like that, and we sweep this form of inducement for this zone. Now we're in a sell here, so good on us, we got in a sell here. Where do we target our trade? So let's draw our sell. So the main idea and the most algorithmic way to target your trade when you're in a scenario like this is to trade to the mitigation cycle. Now what I mean by that is if we have a demand here, like so, we don't want to trade to the demand because at the end of the day, the demand has a valid trading range where it uses underneath that break of structure and it can use whatever's valid there. If we're waiting to, TP at a refinement, it might, miss our TP and then run. Okay, so what we've got to do is basically, if I pull this down a bit, we got to find a main inducement. Obviously, it's got to be a little bit more proximal in a more in a realistic chart approach. But we got to find a main inducement. Then what we can do when we find a main inducement where there's a lot of liquidity that we can manipulate into our point of interest, we can find what that mitigated, which is our mitigation cycle, and we can trade to our mitigation cycle. Now, how do you find the mitigation cycle if you're in a trade like this? Well, what you can do is you can find where the valid point of interest is, and we'll probably have imbalance above. And what you can do, you can use the first level after the imbalance. Now, that's the easiest way to do it, but truly the way to do it is to find exactly what this mitigated. If this mitigated nothing else to the left, that means that's the bottom of the mitigation cycle. I'll just write that quickly. Now, if this mitigated something else, we can use that for the mitigation cycle and we can do it lower. But if we trade to the end of the mitigation cycle, that's trading to the EPA, okay? So if this takes profit, we can do the same thing. We can look for that next mitigation cycle, which will be somewhere up here, okay? But what we're realistically doing is we're taking our already mitigated price, okay? So I just wanted to show you that before we get into the actual examples of how to target the trades. So there's three kind of methods that are highly effective for doing that, and that's EPA, smart money traps, and continuation predeterminism. So with an EPA, just like we said, what we're doing here is we're grabbing the orders from each supply and we're moving them down, okay? Every time we move down these orders, we're mitigating that money down. So when we come back up to meet these points, yeah, we might have some pullbacks, okay? But we're not going to reverse from points of already mitigated money because there's no orders resting at these points. We need to hit into areas with high volume of orders that we can manipulate into. But if price has already been mitigated, we can literally just run all that price action. So that's the first thing we can look at, and that goes hand in hand with our mitigation cycle, okay? The next one is smart money traps. So what are smart money traps? Smart money traps are essentially what people would say are order blocks, but they don't have any inducement. So if we have a supply here, for example, but we don't have any form of liquidity to manipulate into that supply, then we'll either run it or we'll react to it, get what we call a minor inducement pullback, and then keep running to the upside. Same thing going on here. If we have a supply level, like so, we can react to it, get a tiny reaction, even just run it, and then keep moving up. So we need to make sure our POIs have some form of liquidity to manipulate. Another factor of this is we could be resting on equal highs, equal lows. We're resting on a form of liquidity. We don't have a BFI sweep, so there's no manipulation at that certain point of time. Okay, so EPA, smart money traps, and this one's not necessarily a structural thing. It is structural, but it's not necessarily uh, like these two. This is a bit more of being in the trade and waiting. So let's say we're in this trade here. Okay, just just randomly, we're in this trade here. Okay, now we're entering a supply level here that has inducement. So what does that mean? It means it's a valid supply level, and it follows our rules of being valid as well. Okay, now why can I target above this? Well, you shouldn't really, but if you're in the trade, what you can be doing is waiting for continuation predeterminism. That means that a demand, a continuation order block with inducement will form before sweeping the inducement for this supply. So before we sweep this for this supply, we create an order block that follows our rules, and we create inducement for it. Okay, that inducement could get respected, whatever, but because we're creating this, we're showing that we have intent to continue to the upside, so we have confidence to hold this trade. Okay, so it's that intention and that predeterminism the market can give, which can benefit us, especially when we're in a trade like this. Another factor we'll see is from here to here, we'll have either this or we'll have either this. Why? Because we're trapping reversal traders because we're having a pullback and a continuation to the upside. So creating this form of inducement and a continuational POI is what our predeterminism comes into. And yeah, it might mean we have to look at our trade or set alerts at certain points, but you know, do what's best. Just to re-outline this stuff, if we zoomed in, for example, this would either be EPA, right, where all that price is mitigated, so it gives us room to push through, or it can be a smart money trap where it doesn't create a reversal order block. Something like this, right? We hit into the zone and then we just push down, and then we create a reversal and we push through that. A lot of people be selling from here, but we know we're not manipulating any liquidity into that area. Okay, let's look at some examples. We'll try and follow EPA and smart money traps. Basically, we're on the 1 hour. Let's look at this one first, okay? So just have the mindset that we're in a trade here. We're already in a trade, and we're like, okay, where do I target? You know, and you're not sure where to target. So we'll start from the bottom here. Let me turn off these sessions. Okay, so when we start from the bottom, we're in this trade. For example, let me just draw up a fake trade that we're in, okay? And whatever, we'll fix where we target. Now, a first good target would be here, right here. Why is it a good first target? At least we can partial at the bare minimum, but it's a good first target because we have an active zone with a form of inducement. Now, this inducement is obviously inducement pullback. It's not a phase one like we talk about in our other videos. But a big factor to this is because we created a continuation order block to the upside. So not only does this give us confidence that we can hold this trade, but it allows us to be able to take continuation from here. Okay, so this is a valid zone, of course, but because we created that predetermined continuational structure, we're able to hold that. Okay, once again, we took off and created it again, and we created inducement for it. So we're good to go. Now the supply level we reacted from was this one here. Now this level here didn't fully enter that supply. So there's probably a refinement in here that this reacted from. So then again, this does seem risky, but because we created this and because we created this, and this is at Frankfurt, so that's where we start our manipulation, we're able to hold this trade again, and we're able to secure potentially another trade. Okay. So now, okay, things start to connect. So we're in this one. This mitigated this, which mitigated this, which mitigated this. Bang, we got imbalance in there. Okay. So that means we have a valid supply with its mitigation cycle. Now this is a very good TP for these trades because obviously we're going to get a stronger reaction here. It's a strong manipulation wick as well. But then again, what do we have to look at? We have to look at the continuation predeterminism. Okay. And what do we find down here? Another valid demand that formed. So we took that, took out some internal liquidity, we pushed into it, a strong push and a strong push back out, and we continued to the upside again. So if we didn't TP here, let's say we haven't TP'd the first one, okay? If we didn't TP here, yes, we could get a continuational trade. We could wait for our confirmations. Now, confirmations are all based on momentum and structure, which is in our entry system as well. But that does get a little bit more advanced. I don't want to get into that. But now we know that this mitigated this. We got to look for the next thing. This mitigated this, this, right? We have some gap here, okay? But this has no close inducement. This mitigated this, okay? And then we have some form of supply that's available here, okay? So we're following the mitigations, okay? Let's say, in this instance, that's our next spot to TP, okay? Now, this had a much stronger reaction. We took out that liquidity, we reacted strong, but like we've been talking about, we created continuational structure. What did it use as inducement? It used this as inducement to fuel that move to the upside. But that would have been a very good take profit. Due to this being on the 1 hour, this would have been quite a long time to be in a trade. Okay. But let's say we get back in here. Okay, we've realistically just used EPA. But let me look for a smart money trap. So here we go. Let's say we found a break of structure. We found a kind of decisional demand, and we're in this trade now. Okay. Now, lots of people will be marking up this supply, but as we said, this supply doesn't have a form of inducement. It's just a straight bomb down. We didn't create any structural liquidity that we can take out for it, so we can target that high. But also we can just follow our mitigation cycle rules. This mitigated this, to this, to this, to this. We might get a reaction here. As you can see, we didn't. We can see the future as well, to keep in mind. But because that's all mitigated, we can target that. Now this is a high point of liquidity, so we will get a reaction from it like we do. But it's all dependent on what we react to when we take out that liquidity. And then, yeah, we can get continuations and keep doing that. But that's why the high time frame is so important, because it will literally dictate where price is going to go and where it's going to pull back from. Okay. So if you guys have any questions on these three, feel free to leave a comment. It's not a big topic, but it's a very important topic, because what it can do, it can not only help you target your trades, but it can help you see what price is trying to do. So see price as purpose. It's always creating purpose in some kind of way. So try and understand its purpose, its intention, and that'll help you understand its direction and then execution. Okay. Thanks, guys.